What is going on, ladies and gentlemen? I know you guys missed the series, or some of you at least, and I'm going to be reacting to the 2022 Mentorship No Rant again today. So I hope you guys enjoy this video. I'm going to be giving you my thoughts on ICT, what he says, whether I agree, disagree, based off my experience, and kind of be explaining a little more in depth on what he's saying that maybe some of you guys don't understand. So without further ado, don't really have much to say in the intro. Use code DODGE, 80% off. Apex free 50K account, 80% off right now. And out of that, let's get into the video. All right, we will be doing the no rant version. Okay, so there is a no rant playlist, and yeah, we're just gonna do episode 4. Might do episode 5, not sure yet. So let's just get started here.
All right, folks, welcome back. So this lesson is going to be a little bit shorter, more direct to the point, and we'll be looking at some examples since I showed you what we're looking for on Tuesday night. So Wednesday's trading and Thursday's trading, we'll take a look at that. All right, first up is the E-mini S&P March delivery contract for 2022, Wednesday, January 26th. Once you take a look at
I've really talked about this, but I used to use ES back in 2022, 2021, and then all of a sudden NQ became better. Back in like 2 years ago, ES was the better to trade. Look at this. If you compare this ES chart to now, there's way more equal highs and equal lows on ES right now. Then like here, I almost see none. That's crazy. So ES was way better back then. You can just clearly tell. It's way slow. There's a lot more equal highs and equal lows form now. But back in the day, ES used to be better.
this low over here on Wednesday the 26th, and you'll see why I picked that low there, because it's the low. Okay, and then this is the high. So we have this price run from this low to this high. That's our range. So you want to drop your fib on that. Now get your equilibrium price point. So as the highs were ran through, we had that run up. The market gets pushed into a premium. It's really expensive. And
so he's saying drop your fib from here, this low here, to this high here. Like if I were to pull up a chart, he's literally just saying like, here's a low down here, and then we go up, and then he's saying this. So he's saying do this. And basically, I think he's trying to show premium discount. So you basically want to short above the 0.5 and long below the 0.5.
And then we want to wait to see, does it break down below the old high? It does. But does it create a fair value gap in here? No.
Break down below the old high. I've never heard that. I've never heard that before. Interesting.
Then it rallies one more time, then breaks down again. Inside here, there's a break in market structure. We see it here, then it runs back up into the fair value gap here, and then sells off, reaching in.
Dude, he teaches it as if like I already know it. Like if I was a beginner, I'd be so confused here. She's just like telling me what price does, and it's like I already know it. Like price rallies, we hit this high, but we don't create a fair value gap on the way down. But then we rally again, then we create a fair value gap. And by the way, look at this inverse. This is inverse right here. But it, like, if I was new, I would not understand that.
Into this old low, which would be below the equilibrium price point of this entire range, or 50% level on the fib. Okay, put some lipstick on this. Again, here's the low and the high. Equilibrium, which is a 50 level on the Fibonacci. So we're looking for a low or an imbalance.
So you're trying to position, when you get into short, you're really trying to get in above this red line. So from this range here to this range here, you're really trying to get in above this point, red line. That's where price is going to move the quickest. Once it gets below the red line, it's going to be a crap show. Okay, don't short below that.
Below this level. Okay, so we have a swing low here. We have an imbalance here. That could be a target. Notice how we hit it there and came off of it. More pronounced low here. And draws down into that. So inside this shaded blue area, we're going to take a close.
I love how he says pronounced low. You're probably like, oh, why doesn't he say something about like one of these random ass lows? This is pronounced. It stands out. You can see this on probably 2 time frames above. Really well spoken there. I love that. I always tell people, like, I always use like the mountaintop lows and highs. Like they're so obvious. This is a pronounced. The pronounced ones are the ones you want to be using.
Closer look at the details. Okay, we're zoomed in a little bit. Again, still on a 2-minute chart. Previous high, short-term high. and 8:30 in the morning. That starts the hunt, basically. That's what 8:30 in the morning is to me. So we're looking for an old high to be violated. It does so here. Then it breaks. There's a break in market structure. Swing low. This candle over here, that sets the stage. Now you have a opportunity. Does price draw back up into the fair value gap after this candle breaks below here and giving you a bearish market structure shift? Yes, it trades up into that fair value gap. You can go short there. And again, you could target this old low here or that low.
See how, like, this is very pronounced. It's very obvious. Now, look at this. This is a textbook inversion setup right here. And it's at 10 a.m. 10 a.m. is a great reversal time. There's so many things he could be saying right now, but he's like leaving it out because it's for beginners. But 10 a.m. is awesome reversal time. We went above 8:30 high, which you want to be above 8:30 for shorting, below 8:30 for longing. The market structure shift is, in my opinion, why we do not go down here. It's really this is a breaker block. This is a breaker. This is a unicorn setup, and he doesn't say that. This is also an inversion. This is literally a picture perfect example.
Low that was annotated before we zoomed in. And look at the beautiful delivery there. So hypothetical short from here and hypothetical cover here. You would log that in your study journal. Don't use my examples here alone. Go into your own charts and annotate them as well. So shorting around, we'll say 44.19 and covering at, we'll say 43.82. That's the opportunity of the range, but you don't have to have all of that. Again, there's that fair value gap, and that's your candle that would be considered as an ideal entry, and the discount old low as a target right there. So your charts would look just like this. In any open space like over here, you would just type in whatever important factors that you found insightful about this example. How long did it take? Okay, how long did it take from the market structure shift occurring? How much time did it take to get up into the fair value gap? That's real important. How long did it take before it went from your entry down to your target? In time, how much heat or drawdown would you have weathered getting short?
Dude, wow. I love that. I forget that he talks about this stuff. Dude, when you take a winning trade, for me, 90% of the time, a winning trade will not take that long to work. And he's saying note the time it takes your trade to work. I love that. Because over time, you'll realize, like, okay, if this trade isn't worked by this time, like if it hasn't worked before like 10 a.m., just stalling, whatever, then you'll get out. Like, that's gold right there. Gold. I'm glad he says to note that, because that is a very good observation you need to be making when you take trades. The more trades you take, the better you're going to get at knowing when price should run.
Now, if you used this candle's high as your entry point, you technically could have got filled here, but in here, I want to teach you to look at the total range available, and in hindsight, okay, because it gives you a framework to look for how these examples, while they're not exactly the same, they don't repeat exactly photocopy of every single previous instance of it. There's a lot of similarities that you'll find that are reoccurring, and that's the important factor, to train your eye to see it. All right, we're looking.
The one thing I've noticed about ICT is he sounds very shy in this video. Maybe either one, he's shy, or two, he just woke up. I feel like he's gotten way more out there in the last year, and like now he's not shy at all on social media. He'll say whatever he wants. He sounds like a very shy character though in this.
Looking at the E-mini NASDAQ futures for Thursday, January 27th, 2022. This is a 5-minute chart. This is the time frame you start with and you work down. So in the 5-minute right away, we can see the low to the high, and we're looking for a high, and go back in time in your chart and you'll find what this is here. But you have these relative equal highs as well. So that could have been an initial objective, looking for these relative equal highs to be taken out. And does it break down and give you a fair value gap? No, it doesn't. So it wouldn't even meet the criteria there. I know some of you might be looking at this, well, how do you know it doesn't get you in a trade here? Listen to the rules I gave you. They're very specific, and that's what I'm walking you through here. That way you can see it's kind of allowing the market, or really forcing the market, to show you its hand. Once it does that, then you can go in and act accordingly. But you have to wait for the setup. You can't force it. You can't think it's there or it's not. So we have an old high here, buy side liquidity resting above that, and we have a run above it. Once it goes above here, does it go above it?
So I like how he talks, like he's saying, is there criteria to go lower? Like I always talk about SMTs. Well, sometimes we have an SMT, but we don't actually have like a model to go lower. But here he's kind of saying, like, is there criteria? And there's not, because there's never any displacement. Like, yeah, we hit buy some liquidity, but there's not an actual model to go short.
But and break down and then go down below that short-term low there? No, it goes higher. So we just keep waiting for a break lower to get a shift in the market structure on an intraday basis.
So again, you could be sitting there all day and you can never get a break lower. So then you just want to never do anything. You just sit there, you go touch grass.
So we have a swing low here. It trades down through it on this candle here. So right away, at that moment on this candle, as soon as this candle trades through it, you now have an opportunity. Then you go back into the high to that candle's low, and do you see a fair value gap? It's right there. Okay, this market rallies back up, trades into it here. You can be a short seller there, and the market breaks down. One more time, retrades back into it, and reaches below the equilibrium price point. Now you have a couple targets here. You can be here, here, or in the imbalance, and it hits all of them.
Yeah, so obviously an imbalance is a good target because the market moves from highs and lows to old unfilled imbalances. And then see how he marked this high, because this is pronounced. Look how much more pronounced this is compared to this high, this low, this low, this low. This low is very out there. You know, it's very easy to see. So
it goes a little bit further lower.
So yeah, good video. Honestly, that's probably gonna be it for this video. But the one thing, like, sometimes, like, you'll be looking for something and it just never happens. So for example, if I'm on the 5 minute time frame here, right, and I think okay, I just think we hit buy side, so I'm gonna look for a short here. What you want to look for is a bearish for rally gap or in a market structure shift. So what do I need to see? I need to see good displacement through this low and then a bearish for rally gap. But we don't get it. So it just means, okay, you don't get it. You don't do anything. So you just kind of sit out of the marketplace. So like that's what it means. Like sometimes you'll be looking for a short at certain areas, maybe like this high or whatever, and you're just not gonna get them, you know, and that's okay. You just move on to the next day. You move on to the next trade. You wait for PM session. Wherever session you're trading, you just wait. So really good idea. Really good ideas there. I think he definitely delivered them smoothly. At the beginning of the video, I felt like he was teaching me how I already knew it. But I feel like labeling it and putting the lipstick in the chart kind of shows you a little more. And again, I guess that's good teaching there, I would say. Now, if you really don't know how the market, like if you really are new to the market, you might not understand it, but it makes sense. So yeah, that's gonna be it for this video. Until next episode, I will be doing episodes of these as much as possible, just when I feel like it. And yeah, that's gonna be it for this video. Peace.